Hey everyone, this is Rob Keens with goldsilverpros.com. It is Wednesday, February 10th, 2021. As you can see, I'm back home in my studio. So happy to be here after traveling so much for the last 2 weeks. Just feels comfortable to be home in the studio in familiar territory with all of the equipment. Happy to be back home. And we have talked the last 2 weeks a lot about silver. We're actually going to change gears a little bit on the program today and talk about gold because we do cover both of the precious metals market. And there's a little bit different story in gold than there has been in silver since the start of the year, basically. We're going to cover the last few weeks of trading data for you. And I've got a very special revisit of a company that we looked at back in October that I want to take a look at again today because I think their value proposition is continuing to move forward just like we thought it would a few months ago. So we're going to get straight to analyzing the gold market here for you guys. This is the all familiar stock charts that I like to put up, and you can see all of my annotations on here about where we are in the market. This is the shorter term, about a year chart, and I talked before about how we had gold in a steady declining channel, and then we had a breakout in December. And I thought that gold prices would head higher till the end of the year, and we have to wait and see what happened in 2021 once we got the political landscape sort of settled down and other things with the economy and where traders basically determined where they wanted to go. And as basically as soon as we got into the new year, gold has fallen down a little bit. There was a big smash down that occurred at the beginning of the year. And then we've had sort of a gradually decreasing sideways range here in gold. We're trading somewhere in the 1840s today and pretty healthy volume. So pretty healthy volume on that market. And it just looks to me like gold just wants to kind of trade sideways. We've had a lot of excitement in silver because of what we think are impending supply shortages, but we don't think that there's necessarily the same supply shortage of gold. There's more out there. And the catalyst for gold right now, we haven't seen the big news event, a bank default or something having to do with more shutdowns in a big country. So I think gold is just kind of sideways trading right now, and that doesn't really surprise me. Doesn't mean we're still not in the bull market, and I think we are, but I think we're fulfilling that prophecy that I said last year. We saw that big gold run up at the same time silver ran up, that we could trace back down in gold and form that handle to the cup and handle pattern. So we're going to jump back out to the long-term chart on gold, and I'm going to show you exactly what I mean by that. Since 2011, the previous high around $1,900, we have this nice little handle, I'm sorry, this cup formation or bowl formation, if you will. And usually on the tail end of a cup formation, if you get a retracement or a pullback, a sizable pullback that looks like a handle to a cup, and it's not a straight out handle, it's a handle that's about 40, 45 degrees. If you get that and it pulls back far enough and forms like a little handle to a cup pattern there, that generally tends to be extremely bullish for the next leg up of the bull market, whether we're talking about stocks or PMs or whatever the case may be. It looks to me like we're still in that handle formation. So the farther we go into this and the longer that goes on, I think gold could continue to drift sideways and down just a little bit to fulfill that. But that just means we're setting up for the next bull move, and it could happen this year. This handle formation could fill out over the next couple of months potentially, and then we could see the next bull leg of the market. Of course, we're going to have to see some news for that to happen. General economic conditions, something happen with the fiat currency, the dollar, the euro, the Chinese renminbi, or the pound, one of the major ones, or some sort of banking crisis or default in like the mortgage market. That will be, I think, the catalyst for the next big move up in the gold market. So the action that we're seeing here is not entirely surprising. I've been talking about it for the last few months, but I'm still incredibly bullish. I wanted to go over real quick to the GLD, the fund flow. So I'm here on ETF.com looking at their fund flows, and I'm looking at GLD, as you can see up here in the search window, for basically just data through February, last 9 to 10 days. And you can see here the net flows for the SPDR Gold Trust are negative 664 million. So people have been pulling money out of that investment. And, at the end of the day, that's why I feel like that's one of the major catalysts for getting sort of this pull down, but that's okay. Again, this happens when you have a big move up like that. This is a normal everyday correction. It's not a huge in percentage terms. And I think we still have the main catalyst for gold to continue to go up, but this might be the period of time in which you want to take more physical gold or potentially invest in some stocks. And we're going to show you one of those potential stocks here in the second half of this video. I think you may be interested in. They've had some really, really big news that we want to talk about. All right, now getting into my favorite chart on Nick Laird's site, Gold Charts Are Us. This is a pay site. I do pay for it, and I highly recommend it. We look at, instead of silver this time, we're looking at the gold flows and the depositories like the COMEX, the ETFs, the funds, and the E-funds. And they've got this great table here that has just about all of them. Makes it great for summarizing gold flows. And what I like to do is look at this 4-week change chart or column over here on the right-hand side. And percentage-wise, you can see the overall percentage was up about 0.37% if we look down at the bottom of the table over the last 4 weeks. This is the 4-week change. And net of all the pluses and minuses you see here in this column, it's 587,000 positive ounces. So despite the fact that we've had this pullback over the last several weeks, and even dating back to the beginning of the year, we've continued to have positive movement or more purchases of gold than sales. So that tells me the physical market is still very strong. I'm also hearing whispers that while silver is being depleted in the retail market, certainly, and some of the 1,000-ounce bars are getting harder to find, we're getting anecdotal notes about that for some traders in the market. I can't divulge who they are. While silver is really tightening up, people are taking some gold off the market. I've heard from several retail brokers that people are buying gold. So they're not ignoring gold. They're in silver, but when that silver runs out, where are they going to go next? If they want precious metals, they're going to come back to gold, especially if there's some sort of big news catalyst. In any case, for the COMEX specifically, there was about 1.3 million ounces added total, about half and half, give or take, to eligible and registered stocks. So plenty there for trading. If we believe these numbers correct, I'm just taking the face value for purposes of this video, but most of it flowed into the COMEX. So people are putting it into warehouse storage. This is this eligible depository number right here, this middle of the 3 COMEX. Eligible means not really eligible for trading, but it could be eligible if they put it up for trading, but it's really just safe private storage. And then another 632,000 ounces into registered, which you can be put up for trading against a futures contract. So just wanted to explain that for people that may have joined my channel for the first time. What's really interesting in terms of the number of ounces held is it almost mimics the price chart. If we go back to the long-term price chart, we've got this little cup formation. And if we go to the overall amount of gold held in the depository, it's sort of like that, although it's much more to the upside here. The cup would be like this in the price, but it's even more pronounced in the physical. So even though the price has withdrawn a little bit after it reached a new all-time high around 2060 or 2070, people have continued to accumulate. We've had this little modest pullback in 2020 over the last 3 to 4 weeks and total of ounces held, but it's very modest. The physical ownership in gold is still extremely strong and sitting at all-time highs, or at least dating back to 2000 on this chart. So a lot of gold in ownership. People are still holding the physical. And even though we've had this price pullback, we've had positive movement and overall physical purchases across all of these funds in the market. Okay, wanted to get to the COMEX report real quick to tell you guys what's going on. You can see after an eventful January in which we had a big price smash in gold, that volume has steadily just traded down. It's just drifting down. As of February 9th, we had 160,000 futures contracts traded. This is Tuesday, February 9th data. I want you to notice something. There are a few deliveries on the February contract, 2,751. Now, February is a really light month. There's not a lot of open interest. It's about double that. It's about half of what the open interest was on that given day was traded in physical. So people are actually taking physical off of the COMEX. They're standing for delivery in a very thinly traded month. The next big month is the April month. You can see we have all of these numbers here, 395,000 open interest for the April contract. We've had some deliveries exchanged for physical through the London market, 610 contracts. So what this tells me, and we're going to see this data, I'm going to go through the last 5 days with the data, and you're going to see this EFP number get larger. That means people are taking a futures contract for April and exchanging for gold on the London market through the EFP mechanism, exchange for physical, before we get to the delivery month in COMEX, because you can't take delivery on COMEX until you trade that futures contract in the active month. That's why on the COMEX, you see 2,751 deliveries in February, because that's the active month for taking delivery in the US on the COMEX. But the exchange for physical, you can do it ahead of time. So people are taking their April contracts and exchanging for gold in London ahead of time. Those are people front running. And why are they front running? Potentially because gold is cheaper right now and they can get it cheaper and they expect maybe long-term the price to go up, but also they may see what's happening in silver and saying, you know what, I need to take my gold position before we have a run on physical gold, which hasn't happened yet, but that silver run may be motivating people to go get their gold. Now, as of Monday, February 8th, it did have 2,049 deliveries, which is a pretty healthy number. But look at this EFP through the London market. Double that, 4,139. People are getting double that in London. Why are they going to London and front running what could be a potentially big month in delivery on the COMEX? Well, maybe they didn't have their February contract. Maybe they're expecting a shortage. Maybe they're expecting the price to rise. That could be some of the motivation. Let's look at Friday's numbers. 708 deliveries on the COMEX for the February contract. Again, double that to the London market through the EFP exchange mechanism. See a pattern here. All right. Let this get out of the way and we'll go back to the Thursday data. 1,816 deliveries on the February contract in gold. By the way, February is a fairly thinly traded month, and there have been a lot of deliveries of gold for a thinly traded month. So yes, people are still taking it, delivery on the COMEX. 5,091 EFP through London. That's more than double. That's 2.5 times what happened on the COMEX. Again, people are front running the April month on COMEX and using those futures positions to go get it in London. And let's look at the last day that we have data for today, Wednesday, February 3rd. 660 deliveries on the COMEX, 1912 for the April contract through London, a triple in that case. So a lot more gold is moving through exchange of COMEX deliveries through London than it is through the actual COMEX. I find that to be particularly interesting. What it tells me is the big traders, the institutions, the family offices are seeing a potential rise in the price of gold and or a potential shortage in ounces of gold, and they're front running the COMEX contracts to get it out of London or get that exposure in the London market. So we could see a nice little run up in gold here based upon what I'm seeing in the trade data, at least on the COMEX, and what we're seeing in terms of the overall physical. Even though we've had a drifting down gold price, people are taking more physical through all the funds as well. So net, people are still bullish and they're positioning themselves to get their gold early. That's very important. All right, now I promised you guys I would get back to a company that I profiled way back in October. I told you guys they'd be a near-term gold producer. They had to get their mine ready. They had to get all their ducks in a row, but they were getting ready to do it. And that's a sweet spot that you want to get into if you're interested in the gold mining stocks. Gold mining stocks aren't for everybody, but we certainly encourage it if you want to get into that market. And they can be a lucrative market because you get leverage to the gold price. The company does when they produce gold, especially when they can produce it very profitably. Well, this company we looked at can do all of those things, and they've had a lot of news. So I'm going to take you through all the news dating back to last October and tell you what they're doing now. And I think there's reason to get excited here because I think there's a cheap entry point into this company. And this company, of course, is Winston Goldcorp. I first looked at them back in October, so several months ago. They trade on the Canadian Stock Exchange under the ticker WGC, as you can see here, and on the OTCs in the US under WGMCF. They're a high-grade, low-cost gold mining operation, near-term gold production in mining-friendly Montana in the good old US of A. And the one thing I want to pull out of their presentation that I want to highlight, they've got some big-time experience here. They have Joseph Caraba, who's executive chairman. He's a major shareholder. He has a lot of management operational experience. He retired from the board of Newmont, a big-time player in the gold market last year, after spending a decade as a chair of safety and sustainability committee. Prior to Newmont, he was president and CEO of Cliffs Natural Resources. And before that, he spent 20 years at Rio Tinto, another big-time operation. And so they've got a really good management team here at the company that knows what they're doing, that has experience in really big-time gold mines. And Joseph Caraba put a lot of his money into this, and one of the biggest shareholders, because he believes in this project. And we're going to talk a little bit about that project. So here's a cool little video. It has no sound, but it's got nice little animation. So I'm going to narrate this video as we go along and tell you what they're showing you so that you can learn a little bit about the project, because project is one of the main 3 or 4 things that we look at when getting into a company. We want to know that it's in a good jurisdiction and the project itself can get the gold or silver or the base metals out of the ground at a profit. It's not going to cost too much to mine. So we're going to review this video and I'll kind of narrate you through as we get through it. So again, the name of the company is Winston Gold Mining. They are mining here in Montana. Love that, being a US citizen. Montana has over 20 million ounces produced historically. They are near Helena. I've been to Helena before. It's a beautiful city in Montana. I went years and years ago on a consulting engagement. They have infrastructure around their mine. They have existing power lines and road infrastructure. So they're not going to have to build all this out and put a lot of spend on it. Their project is 205 acres, as you can see highlighted on the screen. The district has 100,000 ounces since 1866. 7 of gold produced. So it is a producing region. They're on the Edna trend, and they're focusing on the Custer trend, or the Custer vein, I'm sorry. They've had 46,000 meters of historic drilling, which is really good. When you've seen historic drilling, that means that somebody else has been there working it. You see some of their grams per ton, 55.8 grams per ton, 20 feet on that drill result. And these are their drill results where they drilled down. This one has an 89.7 grams per ton historic. This one, 97.6 grams per ton on a 2014 drill hole. So these are the drills we're looking at, the Custer vein. 2,400 feet long, 4 feet wide. Now this is relatively narrow vein mining, but companies do a good job of narrow vein mining, can make a lot of money. Impact Silver is one that does it on silver in Mexico, and they've been making money for a long time. They restarted that mine in 2007. I've been down and viewed that mine and saw how they do it, and it's definitely possible, and they do make good money. That's been a good stock for us, Impact Silver. Winston's doing the same thing, but up here in Montana on a gold mine, and it's a really, really interesting project. They've had a lot of news. Now I'm going to walk you through the news they had since we last did them in October. Here they're talking about extracting 4,200 tons of mineralized material with an average grade of 0.22 ounces per ton. Now, ounces per ton and grams per ton is different. If you can get about a half a gram per ton or more on a near surface deposit, you can make money off of that. Northern Vertex is a company that's been doing that for the last year, or somebody I've been profiling since 2018. This is 0.22 ounces per ton. There's 31 grams in an ounce. So you're talking about 1/5 of an ounce, which is about 6 or 7 grams per ton. That is way more than you need to make a profitable gold mine. So this is really, really good news. He said in a press release yesterday, we announced that 4,200 tons of mineralized material had come out of the mine with average grade of 1/5 of an ounce per ton, about 6 or 7 grams per ton. That's an excellent average, he explained. We don't know all of the data yet, but as we continue to drift, it will give us more information on those veins. Really good result. This is back in October. We're going to keep going on the news front. In October, they released another news. They intersected 22.7 grams per ton gold and 107.6 grams per ton silver over a 5-foot parallel vein. And they have a nice little chart here. Now, by the way, both of those are really good numbers. This is going to be considered a byproduct credit. 107.65 grams per ton, which is, what is that? Is about not quite 4 ounces per ton silver. I mean, that's a nice little byproduct credit to the gold they're getting. They're getting 22 that's about 30 to 40 times the amount of gold you need to break even and make money on the mine. They're doing really well there. And this table, it basically shows you what they've got. Gold grade, they had 33.69 grams per ton, 16.8 grams per ton, 21.53 grams per ton, and 0.65. Silver grams per ton, almost 100, 92.57, 55.88, 167.31, 6.17. So if you guys are interested also in silver miners, Winston is getting really great silver results in addition to their gold results. And it's just going to be a bonus on top of the gold that they're getting in the ground. It's going to make them more profitable. And with silver price potentially skyrocketing like we think it is, that silver could be subsidizing their mining costs for the gold, or the gold subsidizing for the silver, depending on how you look at it. So I like the fact that they have 2 products here, and I like the fact that they've had 2 consecutive good drill results. We're going to go to November 3rd, and they continue drilling, and they intersected more high-grade gold in a parallel vein, including 1.4 ounces per ton over 5 feet. Really good number there, much more than we need to be profitable. So here are some of the numbers. Ounces per ton, 1.48, which translates to 48.27 grams per ton. I'm on this column here, the gold grade. 119 grams per ton, goodness gracious, over about 0.61 meters, 33 over 0.61 meters, and 134 over 0.15 meters, 134 grams per ton. That is going to be some profitable mining. Of course, silver's doing very well. You got 54, you got 134, you got 42.85 and 141. Those silver numbers by themselves are really, really good. So again, continuing October, November, almost as if proving exactly what we said at the beginning of October, that they were going to begin drilling and they were eventually going to open the mill if they had. They just needed to do some refinement on the mill, and they were going to be set to go. And that's exactly what's happening. So we'll continue to get into more of the news here on their website. They completed upgrades to the Paradigm mill facility. It's a little ways away from their mine, but it's close enough where they can kind of truck it over. It's not going to be expensive. They can go ahead and use that mill facility to get their doré bars, and then they can send it on to a refiner. That's very common in the mining industry, by the way, and not something to be overly concerned with. Lots of companies do this. They've installed a new primary jaw crusher and conveyor belt to feed the secondary cone crushers at the Paradigm Mill, and the company anticipates that the mill will be ready for initial testing in 2 to 3 weeks. We're going to bring you news on that here in a moment. They completed the installation of the crushing circuit at the Paradigm Mill facility, and that's near Radersburg, Montana. Again, about 30 miles from the mine site. Here it says they expect to initially run the mill at 75 to 85 tons per day and process the lower grade stockpile in order to test and tune the mill, which they did. And eventually they're going to ramp it up to 150 tons per day. That's a nice, healthy operation for a small miner. The Paradigm Mill is located just 35 miles away on a paved company road. They just truck it over. It's not that expensive. They anticipate producing doré bars from the gravity circuit. Of course, the doré bars is where you had the mix in the gold and silver. It's sent through the refiner to kind of refine it down into the actual, separate out the gold and silver itself. And then it moves on, into the market. Interesting thing here, Bureau Veritas, big company in the mining space for doing audits and looking at sites and doing some testing as well. They previously performed gravity and flotation tests on selected drill core from the parallel, Custer, and Block 93 vein systems, 3 different vein systems on site. And that alone was able to recover just 5.9% gold and 1.3% silver. That's just the gravity circuit. Then they moved it to the gravity tailings, and they were able to recover 86.7 gold and 85% silver. And and they eventually got it up with flotation to 92.6% gold and 86.3% silver. And Bureau Veritas, when they're there, stated they believed it could be better. So they could continue to improve this and get higher recovery rates, which is really good. The more you can recover, the more you can sell, and the higher your profit is per ton of ore mined. So that's really good news that they had coming out back in November 16th. And the news doesn't stop there, because on December 16th, Winston Gold tests crushing and milling circuit at the Paradigm Mill facility. They announced it now crushing and milling low-grade material from its wholly owned Winston Gold mine through the leased Paradigm Mill facility near Radersburg, Montana. And they go on to say approximately 90 tons of low-grade gold-bearing material was crushed to a size of -1-inch mesh. Crushers run a rate of 30 tons per hour, and 50 tons of crushed material was processed. So a total of 76 tons of crushed low-grade material is put through, and they're doing very well. So the mill has a nameplate capacity of 150 tons per day and hosts a ball milling circuit, which is normal. The ball milling circuits where they put the material in with the ball, these big steel balls, the steel balls rotate around and crush it down to that certain size. I've seen that at a couple of different mines that use that. So that's basically what they did. They're continuing the good news and telling people, hey, we're about ready to get this thing pumped up. So a few days ago, they had a big news release. This is a good one. Winston Gold produces the first concentrate at Paradigm. Winston Gold produces first gold and silver concentrate and ramps up the underground mining rate. Really good news for investors. They produced its first concentrate from low-grade stockpiles at the Paradigm Mill facility. In addition, underground development work on the gold mine has allowed mining operations to increase to a rate of 120 tons per day. Now, remember, the mill can do 150 tons per day. So they're almost at capacity. They're pretty close. So that's about 3,000 tons a month. So they can get that up to 150. They could run that at or near capacity. During January, the mill facility was run continuously over a period of 6 days, and it hired and trained 5 new employees, and so on and so forth. And they were getting 0.05 ounce per ton gold and 1.75 grams per ton gold and 0.78 ounces per ton silver. And it produced 7.43 tons of concentrate. So here are the overall mill results. I want you to look at this table here. Mill test run results, which is the really, really good news here. Tons processed 52.47. Average head grade about 5/100ths of an ounce per ton, which is 1.75 grams per ton gold, which is, again, much more than you need to be profitable. And silver, 26.85 grams per ton. That's just a bonus on top of the gold. And with silver running up, we think it's going to run up due to a shortage. That's going to make that silver they're getting more valuable. Price is going to rise. It's going to make their overall all-in sustaining cost of getting that gold and silver out of the ground fall, or the difference between the all-in sustaining cost and the profit, rather. The float concentrate recovers 6.74 tons. Average silver grade of gravity, 5.07.91 grams per ton. Average gold grade of gravity concentrate, 231.77 grams per ton. So they're doing a really good job of getting the gold and silver out, and they have an underground development update. What they're doing is there's an eye drift above the 4,637 foot level along a 200-foot section. And the I drift represents the first phase of the stoping, which allows the miners to increase the mining rate. So they're building stuff in between the different levels so that they can get basically more out of the mill. They also created, like, this is a different news release, they created a secondary way to get out of the mill for emergency purposes, but another way to get it out. So they're not only are they getting the great concentrate now, they had the great drill results, now they're getting great concentrate and producing doré bars out of it and getting those out to the refineries. They're increasing the rate at which they're able to mine and get stuff out of the mine. That's essentially what this news release says. Super big news. They are spun up and ready to go, and they're going to start producing gold and silver. And this is the sweet spot in a miner. When you have done all the work to either reestablish a mining facility like Winston did, or boot up a facility, and you start producing that gold and that silver, that's when you're going to see the profits start to come in. You're going to have more institutional investment. Investors, the retail investors are going to get more excited. You're going to have a nice rise in the stock price most of the time. So that is just about it for the Winston Gold guys. I think that is potentially a really good option for you. Think about it. We got the gold price drifting down, but the physical is still being taken off the market. That's what we showed in the first half of the video. We think gold is going to follow silver. We're going to have probably some short-term shortages and some increase in the price. We've got all of those economic catalysts for a higher gold price in place for 2021 that we've been talking about for actually several years, but especially over the last 6 months. And here we have a miner that's gotten to the point of being able to run their facility at near production, and they're producing gold and silver in really good profitable amounts for people. So that is really good news. So you've got a couple options here. You can accumulate your gold physical at a cheaper price than we think it's going to be. We think it's in the middle of another big bull run, and we may be close to finishing out that retracement period before we have the next big leg up. And what that's going to do for a company like Winston Gold, who now has production and now is doing really healthy rates of grams per ton, both gold and silver. You've got a shortage in silver, you've got an up leg trend in gold coming out, and you've got a company producing both right here in friendly Montana. Nice US miner there. I don't know what else good news you could have for Winston Gold. So they could be a really good option for a portfolio if you want near-term producers. We definitely recommend getting near-term producers in your portfolio because they tend to stabilize a portfolio long-term. So you have to do your own due diligence here. But again, I showed you all the news. I showed you the progression of exploration and drilling into production. They were always near-term production because they had that nearby facility and they had the previous workings there on site. The one thing you want to look at is they are thin vein mining. So they're not going to go just drill everywhere and pull up all the rock. What they got to do is follow that vein. But thin vein mining works. Impact Silver has done it. I've been down to that mine. They've been doing it again since 2007. Of course, historical workings on their project go back, well over 100 years. Same thing from Winston Gold. A production in this district goes back well over 100 years. They are able to get the rock processed and get the gold and silver out profitably. So I think given the general macroeconomic considerations, the considerations around what's happening with gold and silver price right now, and especially in the physical market, and the fact that you have Winston Gold now booting up their processing for both gold and silver and having healthy gold and silver recovery rates, I think that's going to bode well. And this might be, if you're interested in that near-term producer, which we think should be a stalwart of any gold mining and silver mining investor portfolio, this might be a cheap entry point for you, because once people start getting the news about how much they're producing over the next month, 2-3 months, that price is going to rise because they're going to start to see some profits on the company's books, and that's going to draw attention. There's nothing better than a near-term producer of gold and silver, especially when you're in a gold and silver bull market. I can't say anything else positive about it. So that is your gold update for today. That is a nice little update on Winston. They've done exactly what they said they would do, and we said they would do back in October. It's nice when you see a plan come together, as Hannibal said on the A-Team. I wanted to borrow that phrase. It's nice to see it in a miner, and it's nice to see it in a mining company here in the US. So proud to see that happen. So happy to see that happen. That's going to do it for today, guys. Until next time, this is Rob Keents with Gold Silver Pros.